Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is investing in dividend stocks. And today, we're going to be adding a stock to our example paper money portfolio that is required to pay 90% of income to its shareholders in the form of a dividend. Very interesting type of a stock, but we need to talk through exactly what a real estate investment trust is, what its risk exposure, what their risk exposure is, and some potential, of course, advantages to investing in real estate investment trusts. Should be a great discussion. Before we get to any of that, though, let me first of all say hello to everybody who's already chatting in. Great to see all the familiar names out there, a couple of new names as well. But hello there, Will and Eric, Dinesh, Jim, Lawrence, Josh, Jay Richardson, Eva, JDLMI, and on the list goes as always. Thanks for joining us week after week. We always appreciate your attendance and your contributions to these discussions. If you are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream has concluded, enjoy the recording. That's a great way to watch these webcasts, but be aware that you're invited to join us in the live stream. And if you'd like to be here during the live presentation, this is a Thursday webcast series. We kick things off promptly at noon Eastern time. We'd love to have you here. I also want to let our live stream audience members know that my very good friend Kevin Horner is going to be hanging out in the chats. Kevin's going to be keeping an eye on any questions that come in that I'm not able to get to. Thanks for having my back there, Kevin. Kevin and I would also like to issue an invitation to everybody listening to follow us on social media. You can find Kevin and me on X. You can find Kevin there at Kevin Horner CS. That's his handle. You can find me on X at Cameron May CS. And you can also follow me on LinkedIn. Just go to linkedin.com/in/Cameron May CS. That'll take you to my profile. You can give me a follow there. But let's get into this discussion. Eva says, yay, REITs, one of my favorite topics. All right, very good. Well, we're gonna get into a detailed discussion. Definitely some risks that we need to be aware of with REIT investing along with other types of dividend approaches. So bear these important disclosures in mind. This material is intended for general informational purposes and informational and educational purposes only. There are risks associated with investing in dividend-paying stocks, including, but not limited to, the risk that stocks may reduce or stop paying dividends entirely. Now, as for REITs, risks of REITs are similar to those associated with direct ownership of real estate, such as changes in real estate values and property taxes, interest rates, cash flow of underlying real estate assets, supply and demand, and the management skill and creditworthiness of the issuer of the REIT. All right, so with that important stuff covered, let's set an agenda for today's discussion. We have about 45 minutes to spend together today. So what we'll very first do is have a look at our existing portfolio of dividend-paying stocks. We'll just see how those are coming along, see how priorities for the dividend investor might be accomplished, including laddering of payments, diversification of the portfolio, how much volatility the portfolio might be exposed to. Then we're going to go look at market conditions for a dividend investor, looking through the lens of a dividend investor, and that could be very different from just let's say a normal non-dividend paying stock investor. Then we're going to go find and buy a new stock for our portfolio that seems to be complementary to the current positions, accomplishes portfolio objectives, and today that's going to be a real estate investment trust. But we need to understand what those are before we go and invest in them. So we're going to talk through what REITs are, then make the investment. So let's go right to our thinkorswim desktop platform. Eric, you looking forward to this one? So am I. Yep. We're on our monitor page on our paper money portfolio. Right now, we just have 2 positions. We just kicked off this new webcast series just a couple of weeks ago. So we've been building an example portfolio. And right now, we have 362 shares of KMI, 100 shares of Target. KMI is in the energy sector. Target is in consumer staples. So we're starting to move towards some diversification if that's the investor's priority. Both of these pay dividends, though, in November and every 3 months, subsequent to that, in 3-month intervals. These are quarterly paying companies. So maybe for today, let's make it a priority to try to get something that's on a different quarterly rotation, maybe to spread out that income, make it more consistent from month to month. The yield on these two positions is averaging right around, what do we call that, about 4.15, maybe 4.2%. Our volatility exposure, KMI has a lower beta score, so a lower volatility. Target is slightly above average in volatility. So overall, the portfolio may be leaning a little bit toward less volatile. Dividend payout ratios and long-term debt we can see right here. This is how much we paid for these stocks. This is what they're trading for right now. So right now we're up nicely on our KMI position, down a bit on target, overall up about 2.25%. And that might be a joint benchmark for portfolio performance with a dividend investor, along with the yield that's being collected. So capital appreciation plus yield portfolio seems to be positioned well at this moment. Obviously, things can turn. But overall, that's where we stand. So how about for today, let's make sure that the stock that we select is going to be in a different sector. Energy and staples are already represented. We're going to move to real estate today. We're also going to make sure that let's get our payments going in a different quarterly cycle outside of that November cycle. So before we do that, though, let's go see what's going on with the markets. And there are a couple of things. Now, not every dividend investor is going to look at exactly the same indices that I'm about to show you now, but they could be important for those investors. So let's go to the charts, and let's first of all look at what's going on with 10-year yields. This chart symbol here is TNX:CGI. So this is a chart of the yield on 10-year treasuries, right now about 4.261%. And why might a dividend investor care about what's going on with bond yields? Well, we might think of this as sort of the dividend investor's competition. It may attract the attention and the investment of would-be dividend investors. More investment in dividend stocks could drive prices higher. But if there are more appealing alternatives elsewhere, such as in fixed income, could be a challenge to immediate appreciation, maybe not to long-term necessarily. So this is kind of interesting what's happening with the 10-year yield just recently. We noted last week that the yield had stayed below about 4.2% for the bulk of the last several months, and it just popped up above. So we came up to about 4.3%, sagging back a little bit, but for some, little tilting of the scales, a little bit maybe more toward fixed income. Obviously, we don't know exactly what every investor is going to do. But theoretically, this could put pressure on dividend stocks. Now, lots of dividend investors don't care about what's happening in the short term. Maybe they're just looking at what's happening over the longer term with yields, and those have generally been coming down. At the same time, let's go see what's been happening with dividend stocks. So last week, I introduced you to an index that actually tracks the performance, the net performance of dividend stocks, where dividends are collected and then reinvested. And we just add that to any capital appreciation that's accomplished by that portfolio of stocks, and it gives us this index. Now, it's a little bit of an unwieldy symbol here. So I'm going to pop up here. It's one that we've looked at before. So I'm going to go to our recent, I don't know if you knew you could do this. Not that. Let's go back here to the charts. Anyway, you can use the little down arrow next to your symbol. Click on that. Go to recent if you can't remember a recent symbol. And there we are. What I want to look at here is this one, $SPHYDMUT. Stands for, the dollar sign is an indication that this is an index. The S&P high yield dividend, what's the M that we learned last week? Dividend monarchs. U is US dollar basically, and then T is the total return. So there we go. S&P dividend monarchs index, US dollars total return. So I'm going to select that, and this is what has been happening over the longer term. Let's go to a long term, get that longer perspective with the dividend monarchs, with dividends from those companies reinvested. So for our hypothetical dividend investor, this might give them some insight into how, let's say, not necessarily an average dividend investor might be doing, but those that are investing in things like the dividend monarchs, which are basically S&P 1500 companies that have raised their dividend for at least the last 50 years, and that is every year for the last 50 years. So overall, it's been, as we go to this longer term chart, I said we're switching it to a 10-year chart. More accurately, it's a weekly chart because this index doesn't actually stretch all the way back 10 years. It goes back to April of 2024. But since then, net, what's been happening? Well, it's actually not been a bad run for the dividend companies, up about 11%. However, this is not adjusted necessarily for dividends. What we might want to do, no, actually, sorry, I was getting ahead of myself. We're going to do that for an individual company. But yeah, net, we've been seeing dividend stocks on the rise, but also we can see we've had a real strengthening of performance more recently. Interesting. All right, it's not a guarantee of what's likely to happen immediately in the near future. But let's see if we can stick with that, hopefully that trend over the longer term. But that's a little bit of a gauge of how dividend stocks are doing and how maybe the competition for dividend stocks are doing. But now let's go add a new position to our example portfolio. To aid with that, first of all, we need to know what we might be looking for. And I have also put together a watch list that we're going to be drawing from. I actually have 3 watch lists now that we're going to be drawing from for this webcast series. But what are these watch lists looking for? Or what might a dividend investor have as priorities for investment? Well, number 1, obviously, they're looking for dividends, so yield. Number 2 could be diversification if they prefer to try to spread risk across a range of investments to whatever extent possible. Number 3 is the payment schedule. In other words, how about I'm going to abbreviate this to laddering. That's a term that we're going to get very familiar with during this series. Laddering just means buying or investing in dividend-paying companies that pay their dividends, typically for the ones that we'll be using here on a quarterly basis, in complementary quarterly cycles. So we're not getting all of our dividends, let's say, every November and every 3 months thereafter, or every December and every 3 months thereafter, but getting that more spread out evenly over the course of the year. Number 4 is consistency in paying that dividend. Dividend investor, it might be interesting to them that a company just paid a big fat dividend last quarter, but if it's the first time they ever did it, or if they go up and down in the dividends paid from quarter to quarter, that sort of inconsistency can kind of rattle the cage a little bit for a dividend investor. Maybe they're looking for greater consistency. Number 5, debt can be a threat to the ongoing ability to pay dividends. We've discussed that in the past. The volatility of the stock that we're selecting might be attractive or less attractive to our dividend investor. If they're looking for a smoother ride, well, buying high volatility stocks might lead to more of a roller coaster in price performance while just waiting to collect those dividends. And finally, the net performance. So this is the dividends that are collected, but also any appreciation that the dividend stock itself has experienced from an increase or possibly decrease in the share value. So these are priorities that we're going to be attempting to address each time we make an investment in this example portfolio. So to assist us with this, I have, over the course of the first couple of weeks of this webcast series, built 2 watch lists. One consists of what are called the dividend aristocrats. Those are S&P 500 companies that are at least $3 billion in size, and they've increased their dividend every year for at least the last 25 years. Those are the qualifying characteristics of a dividend aristocrat. So we have a watch list right up here. Now, last week, we also built a scan for what I call the dividend working class, which are companies that meet a lot of the criteria of the dividend aristocrats, just that they maybe haven't paid they haven't increased every year for the last 25 years, or maybe they're not in the S&P 500. So we have that as an alternate watch list. So here we are, we have the dividend aristocrats, we have the dividend working class. I'm going to go for the dividend aristocrats today. So let's bring up those aristocrats and have a look at a couple of them as potential candidates for addition to today's to the portfolio. Oh, Prakash says, is there a script for the working class? Well, there was a scan. It was built using a scan. I actually provided that last week. Let me see if I have it here in my session notes. I do. Here you go. Let me copy that. I'll paste that in the chat window. If you weren't here for last week's discussion, there's the scan link. So when I share a link with you, first of all, be aware that shared links are not guaranteed as to timing or accuracy, but to load those links, we can come right up here, the little gear icon, open that shared item, pop it right in here, then preview and import, and that will load it up into your scans. So you can go to your scan, and if you were on a scan, you could come up here and just load up the scan that's called, let's see, what do we call it? We call it dividend working class right there. All right, now, I also, though, to help us with our review of the dividend aristocrats or the companies found through the dividend working class scan, I have a broader list of watch list columns here. And there's so many of them, they actually can't fit in the little window here. So we just get these dots representing the hidden data there. So we can separate this, give us a larger workspace, click up here, and detach that gadget. So here is a wider view of that watch list gadget there. Let's take a look at our dividend aristocrats. And as we organize these, so my columns here, which are, and maybe I'll share this as well. Let me do this. Let me share. And for those watching on the archive, I'll just put these links in the video description down below so you have access to these as well. But let me give you the link for my Dividend Aristocrats watch list. There you go. There you go. All right. But included in these columns, we have our symbol, we have the sector, which can help very quickly assess whether this is actually going to contribute to the concentration or diversification of our portfolio. We have the market cap. Let's open up this sector just a little bit so we can see that a little bit better. There we go. Market capitalization of these companies. We can see the last trading price. We can see the yield. And I have these organized highest yield to lowest. We just click on the column heading and it'll organize those. We can also see our dividend payout ratio, which is going to be interesting for today's discussion. I want to talk about that. Long-term debt to capital, we can see the beta, which is our measure of volatility. Scores below 1 are lower volatility. Scores above 1 are higher volatility. And we can see the ex-dividend date. But as we organize these by yield, what we'll notice is that in our dividend aristocrats, in our dividend working class, one sector that's going to almost always rise right up close to the top is real estate. Why is that? Why do we see so many real estate companies right up toward the top of these lists so frequently? Well, that's because of the existence of an investment known as a real estate investment trust. So it's a company, more accurately, it's a trust that manages a portfolio of real estate holdings. And by statutory requirement, any profits that are generated from the management of that portfolio, 90% of those profits have to be paid through to the shareholders in the form of dividend. Now, with other publicly traded companies, the decision to pay a dividend, whether it's going to happen or not, is left to the company's board. And they don't always have to pay a dividend. Even if they're currently paying a dividend, they're not required to continue paying the same dividend, if any dividend at all. Yeah, so Paul says REITs must pay more of their income as dividends. Yeah, specifically, it's 90%. But I want to talk about these two. Let's just go with the first two real estate companies that are showing up on our watch list here. Actually, I was going to talk about ESS. Shall we look at FRT? No, I think I eliminated that for another reason. I'll show you that. So let's talk about ESS, not necessarily the first two, but among the first three. So we have O and we have ESS. We can see they are real estate. Might contribute to the further diversification of our example portfolio here. O is substantially larger than ESS in market capitalization. It's about 3.5, 4 times as large. Its yield is a little bit stronger, 5.2% versus 4%, but both of these are multiples of the average dividend being paid by an average dividend paying company in the S&P 500, which is hovering just a little bit above 1%. Now, this is what was interesting to me. Look at the dividend payout ratio of ESS versus the dividend payout ratio of O. And as we're going through these, what I would like you to do is tell me, Paul says O pays monthly dividends. Good observation, Paul. That can be a consideration for our, and I'd have to check that on ESS as well. Anyway, but these ratios are interesting to me. Why are they interesting? Well, we see a dividend payout ratio of 299% on O versus 77% on ESS. What that means is that of earnings over the last 12 months, O actually met their 90% requirement and paid out about 3 times that much. Now, that may be that there are some things that might cause a would-be dividend investor to hit the pause button. So, whoa, hold on a second. That sounds kind of like a lot, and it is. Now, it could be just a one-time, one-off thing where the earnings weren't quite as strong. But in order to maintain that status as a dividend aristocrat, they can't just say, well, we had kind of weak earnings this year, so we're going to cut our dividend. We're not required to pay these big dividends that we've been paying in the past. They just have to be 90% of taxable income. That's an important distinction. But they have exceeded this, likely to not disappoint their shareholders with the reduction in income. Actually, interestingly, with real estate investment trusts, it's more common than not to see these dividends go up and down. So unlike other dividend-paying companies, investors in real estate investment trusts may just kind of accept that most of these companies are going to have strong dividends one quarter, weaker dividends the next quarter, as they're just meeting their 90% statutory obligation, not something else that other publicly traded companies have to deal with. Now, O and ESS, and to be fair, FRT as well, don't fluctuate their dividends like that, or they would not be listed here among the dividend aristocrats. But this is enough, though, for maybe some investors to say, that's a nice track record. But as we're looking for signs of weakness, that might be one. Now, I can't tell you whether a dividend is going to get cut on O or not, but for some investors, they might look at a high dividend ratio as, okay, with payout ratio, the company can do that every once in a while, probably, cover that dividend with maybe assuming more debt. That's a possibility. When earnings aren't there this year, the money's got to come from somewhere if they want to keep paying those dividends. So maybe they take on more debt. You might say, well, maybe it's in retained earnings. Real estate investment trusts aren't really known for having strong retained earnings because they're not allowed to, right? So yeah, this could be taking on more longer-term debt, but as I look at this, it doesn't look like O has more longer-term debt than ESS. So maybe this is a one-off. We'll see. What else is going on here? Well, our beta for both companies is below average. So we have a beta of 0.8, not a highly volatile stock. That's not unusual for REITs. Our ESS is at 0.74. Both of these, though, are paying dividends in a cycle other than, it could be they're being paid monthly, could be they're being paid quarterly, but in a different quarterly cycle. But let's make a choice between these two. So now that we've had this discussion of dividend payout ratios, we can see some of these other variables. Be thinking about which one we're going to be adding to our portfolio. But before we do that, I want to have a little bit deeper discussion of just exactly what a real estate investment trust is, because not everybody watching knows exactly what a REIT is. So a real estate investment trust is a vehicle that was designed, I think they've been around since about the 1960s, but it's a way that an investor might gain exposure to real estate without having to go out and buy a bunch of their own properties, which, as we know, can be highly expensive, especially in today's markets. And especially maybe as we move to commercial real estate. Because an income investor, among other choices for generating income, maybe income earning properties might be attractive. Well, the price of admission there can be very high, though. There's a barrier to entry that may not be accessible to many or even most individual investors. So a real estate investment trust is a company that buys, builds, maintains, manages income-paying real estate properties, and then takes investment from investors and distributes income earned to those investors. And it's that income that I wanted to talk about right here. Another discussion I wanted to have with ESS. This one opened a little window of opportunity for me to highlight something. I just said that these real estate investment trusts are required by statute to pay out 90% of their income to shareholders in the form of dividends. Well, this, if you look at ESS, its dividend payout ratio is 77%, which means that the current dividend is only 77% of earnings for the last 12 months. Isn't it coming up short of that requirement? No, it's not. It's actually still meeting the requirement. Otherwise, it wouldn't qualify as a REIT. But what's happening here is we're seeing the fact that these companies are required not to just pay out 90% of earnings, but earnings or income after depreciation. Yeah, these companies invest in depreciable, is that a word? Anyway, real estate assets, so they can deduct the depreciation of those real estate properties, as a lot of real estate property owners might do, from their earned income. And then what's left over after that, pay out 90% to their shareholders. So yeah, so that explains why this is a little, appears to be on the low end, appears to be contradictory, but it's not. They're still meeting their REIT obligations here. But I did want to talk about just what that REIT is. So a REIT is it's just a company that invests in real estate properties. You invest in that company, or our investor, our hypothetical investor, invests in that company with the objective to collect dividends from any profits that might be generated by those companies. So it might be interesting for the investor to know that not all real estate investment trusts are the same. Some invest directly in hard real estate assets, like hospitals, like strip malls, like individual homes. Others invest in the mortgages that support the investment in those homes. So we have what are called equity REITs, and then there is something else known as mortgage REITs. And mortgage REITs historically have tended to be more volatile. They can have great, even enhanced sensitivity to changes in interest rates, to changes in real estate supply and demand. So Dupuy says yours isn't showing the dividend payout ratio. If one of these columns, for whatever reason, isn't showing, you can add it right here. Just click on this, select customize, and look it up right there. Right? So both of these are equity REITs, investing in physical properties, income-paying properties. How do we know that? Well, before a real estate investor makes an investment in a REIT, one thing they might check on Thinkorswim is to go to the Analyze tab and look at the fundamentals of that company. The fundamentals page includes, let's bring up O. It includes a summary of the company. So this is O, this is Realty Income Corporation. And you can see it's an S&P 500 company, real estate partner to the world's leading companies, founded in 1969. Yep, so if it's a REIT founded in 1969, my estimation of REITs being around since the 60s, probably accurate. Anyway, we serve our clients a full service real estate capital provider. Anyway, but this will describe the kinds of properties they're in. They have 15,500 properties in all 50 US states, the UK, and 7 other countries in Europe. So pretty broad diversification. Now, I don't want this to sound like a sales pitch for this company. This is just how it's built. The investor might want to still bear in mind things like that payout ratio that might be a little bit of a red flag for some. They might look, though, at the long-term debt and say, all right, it doesn't look so bad. Now, comparing this to ESS, lower payout ratio, a little bit higher debt load. User says, why is the price of O low compared to ESS when its market cap is higher? Why do we need to, or what do we need to look into deeper than this? So price per share. As much as supply and demand can also just be a function of the number of shares out there. So to look at two prices, $100 on one, $30 on the other, effectively probably doesn't have any meaning to the would-be investor. It might just be that the one that's trading at $100, there just aren't as many shares out there. And so the price per share will tend to be higher. The other one may have more shares, and so the price per share will tend to be lower. That's it. Okay, most likely that's going to be, when we're just looking at an absolute value like price to price, that's a big consideration. Anyway, so let's look at ESS. And what we'll notice as we move over to ESS is going to be very different. So this one is broadly diversified, 50 US states, the UK, 7 other countries. ESS, much more niche. Niche doesn't mean bad, but it means a niche. So I'm going to scroll down here. Essex Property Trust, it's an S&P 500 company. Fully integrated real estate investment trust that acquires, develops, redevelops, and manages multifamily residential properties. So we know this is it's not a hospital REIT, it's not a commercial REIT. It is a residential properties REIT in selected West Coast markets. So not UK, not 7 other European countries, 257 apartment home communities comprising 62,000 apartment homes, and they're building another one right now. So that gives us some insight into what the portfolio is that the investor is about to acquire if they decide to invest in these REITs. So which one should we choose? Are you starting to lean one toward the other? Maybe one other thing the investor might look to is see what's going on with the charts of these over the long term. Now, this is where I was getting a little bit ahead of myself with our Dividend Monarchs chart that we looked at earlier. When we bring up a long-term chart of ESS or of O, the default chart is only going to be showing us what the share value has done over the years. And if we look at this, if we look at where ESS was 10 years ago, and look at what share value has done since then, where is today's candle? It's right there. It's up about 13%. That's not a lot. However, that does not include all of these dividends. By the way, let's do a quick zoom in here. How often is this paying dividends? 1, 2, 3, 4. It's paying quarterly, right? So that's ESS. Let me zoom back out here, though, because we've learned that if we adjust the chart to reflect dividends, that can be especially helpful to the investor to get a gauge of the total return value for shareholders over the long term. We're not shareholder yet, but it might put us in the shoes of someone who has been a shareholder in the past. So let me click on our chart settings here, and I'm going to adjust. This is an equity we're going to adjust for dividends. There we are. Let's add all dividends to the chart. Click apply, click OK. And here's what's actually happened. Let's remove this original drawing. And price appreciation plus dividends over that 10-year period. Actually, this thing is up about 114%. So it's the dividends for real estate investment trusts that typically carry the day. If our investor has purchased real estate investment trusts and they're out there spending all of their dividends, and then they go look at their portfolio after 10 years and they see eking out appreciation, and if they feel disappointed, it's because they didn't understand how these things work very well, probably. So there's the SS over the long term. Let's also look at O over the long term, including dividends. It has generated for its shareholders over those 10 years about 124% return. Pretty similar. But the vast majority of that coming from the dividends being paid. If we unadjust again, let's go back up here, go to equities, switch this back to just showing any special dividends that have been paid. Click apply, click OK. You can see here we started 10 years ago. Here we are now, 13% again. All right, now let me show you this though, because somebody pointed this out. This REIT, and this is just something I overlooked, that's okay. When we look at a chart, it becomes obvious. This is a dividend, or this is a company that pays not quarterly, but yep, every month. Thanks for pointing that out. That can be a consideration as well. That can still assist with the dividend ladder, but it's going to cause a little bit of a spike in those Novembers that we already own. But guys, let's make a decision now. Let's see if I've missed any questions though. That's a question going to someone else. Oh, I think we're good. So guys, here we have a couple of equity REITs, one that's more broadly diversified, but more recently been paying pretty high payout rate relative to its earnings over the last 12 months. Another one that's a little bit more niche, that's ESS. Both pretty similar performance over the long term, both offering yields multiples of an average dividend paying company right now. Those can be cut, just so you know. What do we think? Should we do ESS or O? Which one should we add to our example portfolio? Has anybody reached a conclusion? Typically what I'll do here when I throw out their question is the first one of our symbols to get 3 votes is the one that'll be added to the portfolio. So just chat in now, O or ESS? What do we think? Paul, was that a vote for ESS because it looks like it's been paying for 31 years? Oh, look at that. V. Anderson, Sharon, Eva say O. All right, so we're going to add some shares of O to our portfolio. So let's do that. Let's go to our trade tab. And in this portfolio, we've been committing about 5% of a hypothetical $200,000 portfolio to each position. That's about $10,000. So that would get us about 150 shares. 100 shares would be about $6,100. Let's, how about we be precise? But last week I was a little bit lazy and used a round number. Let's get out our calculator and let's say we have $10,000 to spend. Let's divide that by 61.55, although that's not our guaranteed purchase price. 162 shares. Okay, so we're going to click on our trade tab. We don't need that exposed down there. Let's click on our trade tab, make sure that we're looking at O, click on the ask price, and we're going to buy 162 shares of O. Let's make that purchase the market price. We're investors here. Maybe a trader cares whether they pay a penny less or a penny more, or a nickel here or there. But an investor, if the thing's qualified, if it's paying the dividend that we're hoping to collect, if it serves the portfolio diversification purposes the trader might or the investor might be looking for, we're just going to buy it. So let's click confirm and send. buying 162 shares at the market price, whatever that turns out to be. We're not guaranteed that we'll fill at 61.55, likely to be in the same area, but we'll see. There is not a payment or not a commission on this investment, but there can be on some types of trades. All right, but let's send this order off, and let's see if we can get that filled. There it is. Bought 162 shares at 61.55. Guys, one thing I wanted to tack on here at the end is if this is your very first exposure to real estate investment trusts, or if you feel like you just need to brush up on your knowledge of these things, the pros and the cons, maybe a suggested way or two that someone might evaluate a potential real estate investment trust investment, we actually have a written education on these things. So if you go to the education tab and explicitly to the education sub-tab, oh, look at that, it's gonna make me log back in. Hang on just a second, I'm gonna do that. I'm gonna drag this over to the side. Let me quickly get logged back in. And there we go. All right. Let's pull this back over into your view. There we are. But as we go to the education tab, and we click on the stocks heading up here at the top, just scroll down through the stocks until you see the courses, and there's one specifically for income investing. And within that income investing course, you'll see the, right down toward the bottom, REITs Foundation. Talks about what REITs are, how to, suggested potential way to measure the REIT quality, benefits and risks of REITs, and then there's a little quiz just to make sure that you caught everything. Great resource there. I'd suggest you check that out. If you're a fan of Scott Thompson, there's even a little video that Scott made in there. So another additional resource. I hope that's helpful for you. But guys, we've accomplished what we set out to do today. I wanted to look at our example portfolio, see what its needs might be. We looked at the market conditions for our hypothetical dividend investor. Then we had a discussion of what are real estate investment trusts as we added one to our example portfolio. Talked through the pros and the cons, provided some tools for the potential analysis of two REITs when one is being considered as a potential investment, and then we placed that investment in the portfolio. Guys, I hope you enjoy this dividend investing series. I really enjoy it. I think it's a great addition to the lineup, so I hope you'll put it in your schedule to join us again next week. But I do have some suggestions for you here as we turn you loose to go enjoy the rest of our educational offerings. And that is, make sure that you're aware of the full slate of educational offerings from Schwab, including, if you're new to these webcasts, make sure that you've subscribed to our Trader Talks channel on YouTube. So this is where you can find our live streams. You can join here. You can also access our playlist for previously concluded webcasts, and you can do searches for topics of specific interest through our archives. But as an example, if you want to find the playlist for this new Investing in Dividend Stocks webcast series, you can click on Playlists, and it's right here at the very top left. Just click on View Full Playlist, and you can see here are the previous webcasts. This is our third one into the series. So enjoy those first two. Now, as you subscribe to the channel, just be aware it doesn't cost anything to do that. It only takes a second. You can just go down below the video stream and click on the subscribe button. Another thing that Kevin and I would strongly suggest you do is follow your favorite Schwab presenters on social media. You can find Kevin and me on X. Just go to x.com, log into your X account. You can find Kevin on X at Kevin Horner CS. You can find and follow me on X at Cameron May CS. I'm very active here. And when I post, if you reply to one of my posts, I reply right back to you. Like I just posted a video here for how to load up paper money for Thinkorswim and live trading on Thinkorswim. How to have both of those sessions running at the same time, but make sure that we don't confuse the two. That's important. It's a little video there. But if you reply to these posts, I just try to reply right back to you. But you can also now follow me on LinkedIn. Just go to linkedin.com/in and then /Cameron May CS will take you right to my profile. Give me a follow here. I also post here and I reply to comments on my posts as well. So it's the place to connect with me in between these live streams. But guys, thanks for giving me your time today. Thanks for everybody who's clicked the thumbs up already. That's always appreciated. I could see 134 people watching. And as I refresh my screen over here on YouTube, 46 have already clicked the thumbs up button. Very much appreciated. That's like applause to us. It really feels good for us to see those likes coming in. But it also gives a boost to our webcast in the YouTube algorithm, helps more people find these discussions like what in the world are REITs? How might an investor evaluate those on Thinkorswim? All right, everybody, go have a great day. I will see you in a future webcast. I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy investing. Bye-bye.